Good morning, ladies and gentlemen. Well, something unusual has happened in the model, and that is that it's gone to the highest score bin. So anything over 85 is a very, very high score, indicating that over time equities should outperform strongly. The interesting thing is here in the model score research, which gives you the expected performance when the model has a particular bin score. And now that we are in the highest bin score, it predicts a mean return of 4.5% over the next 60 days, which is significantly higher than the normal return you expect from the SPY. Just something to bear in mind. It's not written in stone, but it's basically saying that any dip in equities, the odds are that you have to buy them via call spreads or whichever other way, because the upside is going to get squeezed over the course of the next 60 days. It would imply a Fed which is accommodative, and or inflation may be slightly above target, but something that the Fed is not worried about, and therefore bonds remain steady and enable equities to rally. That is what the model is saying. Does not mean it's correct, but statistics does win out in the end. So I'm going to mark down this S&P level and have a look at this score in 2 months' time. 4.5% is the mean return over 60 days. Over 40 days, you can see it's 2.9, and over 1 week, it's actually almost nothing. But all these probabilities rise with time. Having said all that about equities, let's have a look at what the Fed's dilemma here is. We have a forecast, and this is from the Summary of Economic Projections released in December. We have a forecasted real GDP in 2024 of 1.4%, and the latest estimate from GDP Now is 2.9 for quarter one. Well, it's probably likely to be slightly lower, but still significantly higher than this 1.4 that they have for 2024. And you can see that the range is from 0.8 to 2.5. So we are busting through on projections through the top of the highs of the GDP expectations, while inflation is really, if you have a look, 0.4 to 2.5% in the range is actually slightly above the range, which would basically mean that we should be losing some dot plots, and the dot plots are here, and this is the 2023 spread. This guy here is obviously on crack and he needs to come back. And these guys here are, policy is restrictive and they're saying they're not going to move the rate. Well, these guys here are probably not right either, but definitely these guys could be coming back up to the central tendency. And therefore, on an average, you would probably have something like a 10 basis point tightening from the Fed expectations, which were released in December of 2023. That would mean less than 3 cuts in 2024, slightly less, and maybe these guys, certainly this guy here or that guy there, need to come up more to the central tendency for 2025. And, that would give you a tighter expectation of where policy will be in 2024 and 2025. So the short end should remain under pressure, and let's have a look at that. Using the CME's tool, if we pencil in now a cut only for June, I think the probabilities of March have to be at 0. May is also coming off the table, I think, after those CPI and PPI numbers, because now we know that PCE released on the 29th is going to be 0.4 or higher, which basically gives you June as the probability for a cut. I still think they will cut because the odds, I mean, not the odds, but policy is restrictive, and we'll have a look at that later. A cut in June and a cut in July, then I'm pretty convinced that they do not cut ahead of the election in September. This, is debatable whether they cut in November or December, but if you change this from a 25 to 12.5, because as I showed you in the dot plots, the odds are that we are 10 basis points away. But even if you change that to something like 20, because that is where the market should be, and you recalculate, you can see that anything from September out to December out to H5 is still rich, but certainly December is still rich. I just don't see any hope for these to go up very much, and I think any kind of a rally is a sell unless and until we start getting weak economic numbers that push the dot plots back down and or speed up these cuts. To me, these are dead contracts. The term premium is slowly going back up to 0, and I think that with all the issuance this year, the likelihood that term premium is going to remain at negative 20, 25, it's just an absolute floor, I think, here. And with time, it should tend to stay at worst around 0. Now, let's have a look at the real rate. Now that is the thing that will bother the Fed and give them a dilemma, because we are, from 170, we are back at around 2%. And the likelihood that it goes down is not very high, simply because the Fed is pushing out the cuts, and therefore policy will remain restrictive for a longer period of time, because 2% is definitely restrictive policy. If we go back in time and have a look at what this means, this basically means that we haven't been this restrictive since 2009, and then it was coming down. So for the past 15 years, this is the most restrictive policy we've had. Is that really warranted? Is inflation that much of a problem? Probably not. The further out they push in time the beginning of the cuts, the more this is likely to slightly rise with time, because as I showed you, I don't think with the level of issuance it's possible that the term premium remains very negative. And therefore, the likelihood is that the economy does slow down over time, and therefore they will start cutting. So I think that this is going to be an interregnum, as it were, a time when the short end just cannot rally, the long end is weighed down by the issuance, and therefore you get a relative stability, and that is conducive to real rates going up, and that should moderate the pace of the economy. And basically that is what the yield curve is saying. It's saying that as we slowly flatten by a little bit in 2s, 10s and 5s, 30s, that will bring about the necessary conditions for the economy to slow and for later on the markets to rally. At the moment, 2s10s, they're going towards 47. I think that will actually be a good level to make a stand, 47 to 49, for another steepening. And 5s30s, we are basically going to these levels around -7, -10 to -7, and I think it's going to be very difficult for the yield curve to flatten more than that. We are just not in that kind of environment. I don't think the issuance will allow it, and for the 30s to do much better, and the 5s are going to get pinned by these expectations of cuts, whether they come in 2024 and or 2025. And of course, the more they get delayed, the more the curve gets flattened, or the expectation of delay increases. But at some stage, it will reverse very, very strongly. I still believe that this year we will end up with 5s30s well below this kind of level, probably somewhere down here. That is all that the yield curve is saying, and the individual contracts are basically saying that we are slowly returning to this kind of equilibrium that we stayed at for a long time, where we just could not deviate away. We deviated 10 basis points, but we always came back to this 475 level in 2s, and in 5s that level is around here. It's between 440 and 449, and in 30s that level is basically here around the 450 area. Very difficult to move away from there, which is precisely what actually the German curve is saying, is that we're in a period of stability. I think that as time goes by, the MOVE index just cannot sustain these levels. I am convinced that the MOVE index at some stage breaks these levels and goes considerably lower, but that will probably be when the Fed finally starts cutting. The German curve is flattening just like the US curve. This is 2s10s, 5s30s. It's all flattening, and for exactly the same reasons as it's flattening in the US. So there is very little really to think about in terms of the outrights. The Schatz is probably going to fill this gap that it has, and it's going to return to these kind of levels, 294, 295, and that is where you start making a stand. The 5s are probably going to fill this gap here and trade this 245 or 47 area, and that is again where you start making a stand, because I don't think it can remain at those levels. At any kind of weak print, it'll go substantially lower. 10s, of course, the one that's least affected with the 30s, because the yield curve is flattening, but I think even that can definitely reach this kind of level, 252, and touch these levels. And that is all there is to it. I don't think that this is going to continue forever. I think all we're doing is we're taking out the December pivot, because we all realize now that it wasn't a pivot, it was more of a warning or an intention of what the Fed and the ECB want to do. But certainly for me, if we have a look at what the differentials are, they're getting, it's all moving that way. 2s, they're moving out. 5s, they're moving out. 10s, they're moving out. It does seem that the market just cannot sustain this 172 differential, and that the market is saying that over time we are going to have higher levels in the spread, i.e. that the dangers of something bad happening in Europe are higher than the dangers of something bad happening in the US. So therefore, I really would expect this market to go back up towards this 202 level, but probably not break it for a long time. So what are the charts saying? The charts are saying favor longs in Europe over longs in the US, but it's marginal. And B, you have to really be looking at very precise levels if you want to trade the contracts from the long side. What is interesting is that Italy keeps on outperforming Germany, even with the issuance that Italy has compared to Germany. And that tells me that people are quite content to invest at a higher yield. Italy is a higher yielder by 150 basis points at the moment. It was 172. But it tells me that people are convinced that longer term rates are going down. And therefore, let's get something which has as close to zero carry or positive carry as you possibly can. Why lose carry in German 10-year paper if you can buy Italian paper and have positive carry on it? So I think it's as simple as that. This spread will continue to be under pressure for as long as people don't expect the cuts from the ECB to be imminent. And it's actually a good indicator. What it's telling you, or what it will tell you when it starts reversing, is that people are expecting imminent cuts. So for the time being, I think every rally in this spread is actually going to get sold simply because of carry considerations. In the OAT, which trades technically superbly, I'm trying to triangulate that with the other European contracts. I'm becoming more convinced that this 296 to 303, 304 area is going to be a wonderful opportunity to buy some calls. I do think it gets there, but I think that when it gets there, buying 3-month call spreads is going to be a great opportunity, because at some stage I would expect it to trade back down here. And that is the only thing I'm really looking to do in Europe. This kind of level, 303, 304, I think is going to be amazingly pivotal. And the risk reward at those levels in everything European starts increasing exponentially for a big rally later on in the year. Well, we've had something like 6 consecutive weeks of the Dixie closing higher. It hasn't gone very far, but what I'm trying to say is, unless these interest rate differentials now really start moving, and I don't think they will, I think we are, talking about 5-10 basis points, you are very close to not a top, but a level that it's going to find hard to sustain, and therefore the technical reactions are going to be lower rather than higher. I still think that if you see it come back, and I don't expect this next week, but over time, if you see this 102.82 or even better this 101.92 level, the risk reward is definitely to buy it. The bias is still to the upside. I just think it needs a couple of weeks of going sideways to down to basically clear out all the people who got long at bad levels. I mean, the level to get long at was, below 101.92 when I told you a couple of weeks ago. These levels are now overextended, and I think the risk reward for the next 2 or 3 weeks is actually, something like 102.90. And there, I really don't see any reason to be short of dollars, because nobody is going to out-hawk the Fed, and until the Fed is good and ready, the likelihood is that other people are going to have to, other central banks rather, are going to have to blink before the Fed does. What does that mean in terms of Euro USD? Well, it means levels like this. 108.40-ish to me would be a level that this market can definitely trade next week. But anything above that, anything, 108.80 gives you a decent opportunity to fade it. I really don't think it's going to go much higher than 109. And that is all you're looking for. Any kind of weakness towards 109, you want to be looking for opportunities to trade it back down over time to around this 106.30 area. I think, the volatility here is going to remain low because the differentials keep on being the same within 10 or 15 basis points, and therefore the likelihood is that this is going to move at a glacial pace and only come down when the ECB starts blinking, which won't be for several weeks. As I've been saying for several weeks, just avoid gold, be a better buyer of dips, but you're looking to make 10, 20 bucks, and that's about it. And I think that this trend continues. I don't see gold going through the 2000 level simply because I don't see the dollar going that far on the downside versus the euro, i.e. euro up that much, i.e. Dixie down that much, and I don't see the 30-year bonds or any other part of the curve going much more than 5-6 basis points over the course of next week. Therefore, any dip down to 2000 I'm a buyer of. Now, is it going to go that far to the upside? I think the upside is probably at the moment limited to something like this, 2055. But, 20 bucks is worth having kind of thing. So if they start selling it to 2000, I'm a buyer of call spreads, and 2050, 2060, I'm out. I don't think this is a market which can move now. I just don't see any reason for it to do so. DBC is scaring me, and I just can't triangulate it against what the bonds are saying and what the yield curve is saying and what I think the Fed is going to say and do. The problem is that this market is as weak as a kitten. It just cannot rally off this extremely important 2175 area, even though oil is doing better. And what does that tell me? Well, it tells me that everything else is very, very weak. If DBC is 60% energy, what does that imply about the other commodities? It implies that they're very, very weak indeed. I think any kind of a weekly close below 2175 opens the way for the lower Bollinger Band, which is going to be, let's call it 2075. And that is not an insignificant move because it implies a move in oil as well. And if we have a look at oil, it's actually been doing slightly better, but that would mean a complete reversal and a move back down towards the lows. I quite like oil. I think it's not bad, but it just does not translate to what DBC is doing, and I'm very, very afraid of it. If we look at copper, it reversed nicely last week from this 3.67 area, and I just don't understand where the enormous weakness in DBC comes from. But while DBC is holding that 2175 area, I think the risk reward is in being long of it via options or via owning a put there that gives you a soft stop, because it should be going back up, but it just isn't, and I just can't understand it. It's Nvidia earnings on Tuesday. What can one say? I mean, depending on the earnings, of course, I think they will sell the market regardless. That's going to be the first reaction. So where would one want to buy the market? This is the first kind of level, 16,950. That's where risk reward says you probably want to be long. Why would they sell the market? I think Nvidia has a long history of rallying into earnings, spiking on the earnings, and then coming down and doing nothing for about a month, and then repeating the pattern. I don't see why you shouldn't repeat that pattern. So I think that the likelihood of lower prices at some stage next week, before we even think of rallying, is higher than a continuation. I can't see a continuation simply because we are so far above the monthly Bollinger Bands, and as I keep on telling you, it just doesn't last, or it's retraced the month after and then it goes. I just can't see that happening, but we don't have a lot of Nvidia component in the S&P, certainly not nearly as much as we have in the Nasdaq. So a move there to something like 4,900 would be, in the SPX, would be what one would expect to see and be ready to buy. It's one of those. I just can't see the market sustaining these levels once the earnings are out of the way. But I am a dip buyer simply because I do believe that the model is right and that in 60 days' time we'll be substantially higher than we are now. It just for the next week or two, and certainly going into the Fed, it's very difficult to see that people want to take on that much more risk if the probability is that they take away one of the cuts, or not the probability, but the possibility is that they hike and make the dot plots go slightly higher and postpone everything in the market's mind. So it's going to be very, very difficult for the market to rally now. I would favor a rally from levels where people have sold, anticipating bad news from the FOMC, and then a rally on those news, i.e., to the realization that things aren't that bad. So I'm a buyer of dips, and I will not buy up here, not ahead of an Nvidia, and if anything, I mean, my own position is hedged. In the Nasdaq, I don't want the Nvidia risk over Tuesday. I just don't. I think at volatility at 17% in Nasdaq, if you are not hedged, you are not playing the odds. What I do think there is a reasonable chance of is actually one of those rare periods of outperformance of foreign markets versus the US. And as you know, EM, I still like it for 42.25. It managed to close above 39.93. I think the risk reward is to play it for the upside. Now, if you think, how is the outperformance going to happen? Well, if you get a setback on the Nvidia earnings, then after that, the SPX and the NQ could do nothing but range in a 2-3 point range on the, sort of 3% from the highs, while everything else starts rallying. And I certainly think that the odds are favoring a rally in EEM, and a continuation or over strength above the SPX in the Nikkei, because there's very little to tell me that this is an absolute top in Nikkei. It might come down a couple of percent, 1.5%, something like that, and then continue while the SPX and the NQ don't do very much. And certainly, I think that the European market, this is a doji. It doesn't know what to do. It might come back a little, but then keep on going. I certainly think that Europe will trade 48.50, and there is just too much impulsion in Europe for it to, can it come back down to this 45.80? Yeah, sure, but it's going to be such a wonderful buy. I just don't see that the foreign markets are ready to give up the ghost yet. And that tells me that there's going to be outperformance, or at least I hope there is outperformance in EEM, in Europe, and in Japan over the US once NVIDIA earnings are over. And why then would you buy the US? For those of you skeptical that EEM can go up while the SPY doesn't, well, this is a weekly chart. Okay, this is a weekly chart, just gives you an idea of how far the outperformance has been in the past few years. And here we are. Just to get back to the levels that we were trading in December, it's an 8% move. Okay, so if I'm looking for 42, which is 4-5% move, it can easily happen while the SPX does nothing to goes down. So I'm just giving you the proportions that this thing moves, and why I think at the moment the risk reward has to be long other markets compared to the US. For what it's worth, I've changed the levels. There's very little going on, especially in the bonds. And my favorite trade, as you can probably gather, is to be long of foreign markets, foreign equity markets against the US, especially once if you get a spike on NVIDIA earnings. So in my long only book, I have it hedged, and I'm looking to go short the US against the longs in EM and Europe and wherever else. So I'm looking for some kind of a 3-4-5% move, relative move of other markets relative to the US. Now, whether that comes via US coming down and the other markets doing nothing to going up, or the US doing nothing and the other markets going higher, I don't know. But I think that after NVIDIA earnings, the odds revert to the US going a couple of percentage points down rather than staying at the level it is and then rallying later on in time. I don't think the US outperformance, I'm not calling a bottom in the US outperformance. I'm just saying that for the next 2 or 3 weeks, that to me is the likelier path. Thank you very much indeed, and tweet you on Monday, even though it's a holiday, but I'm sure the markets are open. If I see something, I'll tweet.